Benjamin Graham is considered to be one of the most influential investors of all time and is widely known as the father of value investing. His investment philosophy and techniques have been followed by many successful investors over the years. In this video we will learn how to use his valuation formula and the Graham's number valuation to evaluate the intrinsic value of a stock. By the end of this video, you will have a solid understanding of Benjamin Graham's investment principles and be able to apply his techniques to your own investment decisions. If you want access to the models that we will build in this video and many more models, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's get started and learn how to evaluate a stock like Benjamin Graham. Benjamin Graham uses a number of metrics to determine the intrinsic value when using his formula. These metrics are the trailing 12 months earnings per share, the PE of a company with no growth, the growth rate expectation, the average yield of AAA corporate bonds, and the current yield of AAA corporate bonds. Some of these metrics are already a standard number, like the PE of a company with no growth. In his thesis, this is 7, and the average yield of AAA corporate bonds is 4.4, so we can already fill these ones in. As an example, let's do this valuation now for Johnson & Johnson. If you want to get the trailing 12 months earnings per share, we can go to Yahoo Finance, which I'll leave in the description. You can see here the earnings per share, the trailing 12 months was 6.79. So let's fill that one in. 6.79. The growth rate expectation we can also find on Yahoo Finance. For this, I go to Analysis and I scroll all the way to the bottom, and then we see growth estimates. And I always use look at these two and take around the middle. So in this case that would be 4.5. So we fill in 4.5. And the current yield of AAA corporate bonds, I use the website Fred Economic Data, which I'll also leave in the description for you to check out. As you can see here, it's currently sitting at 5.12. Let's fill that one in as well. With these metrics alone, we can already determine the intrinsic value. So let's do this, intrinsic value. And let's fill in the formula. The formula goes as follows. We want to do a is_sum function, and then bracket open. We want to take the trailing 12 months earnings per share and multiply it by, and then bracket open, by the PE of a company with no growth plus the growth rate estimate. Now we want to do it bracket close, multiply, and we then multiply by the average yield of AAA corporate bonds. And then we want to do a bracket close again, and we want to do divided by the current yield of AAA corporate bonds. And here we already get our intrinsic value for this company, in this case Johnson & Johnson. What we can now do is we want to see an upside in dollars and an upside in percentages. So we want to fill in the current price, the upside in dollars, and the upside in percentages. So the current price of Johnson & Johnson is $154.02. $54.02. I want to see an upside, and we use this this formula for this. We want to take the intrinsic value minus the current price. So we see there's a downside of $86.92. And in percentages, we want to do is the intrinsic value divided by the current price minus 1. And if we make this percentages, we get our downside in percentage. So this is the entire Graham's revised valuation formula. In addition to this one, I have another valuation formula that Graham also invented that I don't use on my channel, but I still want to let you know, and I still want to cover this. This is Graham's number. So we'll also build this one. In this model we look at the following metrics. The ideal PE ratio of a company, the ideal price to book ratio of a company, the earnings per share, again the trailing 12 months earnings per share, and the book value per share. And with these metrics we can already determine the intrinsic value of the stock again with another valuation formula. Intrinsic value. So let's check. The trailing 12-month earnings per share of Johnson & Johnson was, as we can see here, it was 6.69. 6.94. And we want to get the book value per share. For that, you want to go to statistics. And here, if you scroll down, we can see somewhere here, yeah, book value per share. And that is 29.39. Let's fill that one in as well. 29.39. And the ideal PE ratio and price to book ratio, determined by Benjamin Graham, are 15 and 1.5. Oops, 1.5. For this model, we use the following formula. It is square root. We want to get the square root of this one. The ideal PE ratio multiplied by the ideal price to book ratio multiplied by the trailing 12-month earning per share multiplied by the book value price per share. Or book value per share, rather. And with this, we get the following valuation. Looking at these, we can see that it's actually relatively close to the current intrinsic value out of the other model, which is kind of uncanny. So in this one, we would also want to do the current price, upside percentage, etc. So what we want to do again is get our current price. We want to just import it from the past sheet. And we can do the exact same formulas. Intrinsic value minus current price is our downside. And then to get our upside in percentages, in this case downside, what we want to do is intrinsic value divided by the current price minus 1. And we get our downside once again. I hope you enjoyed this video and learned something from this. If you want to see more of this type of content, please let me know in the comments. And thanks for watching.